Good morning, everybody. In today's video, I will show you a very interesting chart, which is the ratio between US bond index and the S&P 500 total return. Then we will discuss a trading model I follow, highlighting overbought conditions on different stock market indices. Then I will make an update on the IBEX 35 index, which we discussed last week. So the interesting ratio I wanted to show you today is the ratio between bond index. So this is the Bloomberg Barclays US aggregate government bonds. So this is the total return index and divided by the S&P 500 total return index. So more or less, this is a ratio between the relative performance between a bond index and an equity index. So this ratio is back to its lowest level ever, so all-time lows, highlighting that US bonds are becoming very cheap relative to equities. I find this index very interesting, this ratio very interesting, first of all because the ratio is hitting its lowest level since the year 2000, so which was obviously an equity bubble. So the last big equity bubble, we also had 2007 here. So right now, the relative value of equities against bonds seems to be completely overstretched. It does not mean that we are close to having a huge reversal of this ratio, but at least it shows that the relative value of equities against bonds is extremely high. So most people think that there is a risk of a bond market crash here, with yields rising above 3%. But in this case, I'm not sure that going short bonds will be the good strategy, because I think that in this case, equity will probably suffer more than bonds. So this is something very concerning regarding the equity market. Now, another indicator I would like to discuss with you on equities. This is an indicator I follow. So I programmed it on Bloomberg. It's a combination of overbought signals. So I use two components in this signal. So as you can see here, so all the red dot highlights overbought conditions on the indicator. So here you can see that in most cases the index starts a pullback. So this is a daily indicator, so it's not a long-term indicator. It just highlights periods of tension on the market. And sometimes the market keeps rising, then start a consolidation, so at least a flat trading range. So right now, as you can see here, so this is the DAX 30, so European stock market. Right now, European stock market after 4 weeks, 4 very bullish weeks, are becoming overstretched. Euro Stoxx 50 is showing a similar picture, so highlighting overbought condition for the first time since May. This is also the chart of the S&P. So as you can see, this is the first time we have overbought condition since February. So this is a bit different compared to European indices, and also an indication that according to this measure, the US stock market is also becoming a bit overstretched on a daily basis. So last, to conclude this presentation, last week I discussed the outlook of the IBEX. So what I was telling you is that the IBEX was trying to bounce off its 200-day moving average, and breaking above the declining 50-day MA was very important to confirm the short-term bull trend on European equities. So what we saw over the last few days with the Catalan story is instead of a breakout, a breakdown. So the IBEX dropped below its 200 moving average. I don't consider it as a major technical event because the 200 moving average is rising. But anyway, it shows that so as long as the IBEX remains in a downtrend, so you can see it here, I think that there is a mismatch between the rise of the DAX, Eurostoxx, CAC 40, etc., and the decline of the IBEX. So I still need to see a confirmation of so a significant bullish reversal on IBEX to allow further rise of European indices. So once again, it will be a very important index to keep monitoring in coming weeks. I didn't show you the chart of the stocks banks, but I will probably discuss it in a daily at the start of next week. This is also a very important index. Thank you very much and have a good day. Bye.